So what exactly is liquidity in trading? And how do we identify and trade liquidity grabs and liquidity sweeps, step by step, to make money? Well, the very first thing we need to do before we can start trading our liquidity grabs and liquidity sweeps is to answer the very important question: what is liquidity in trading? And here I think that liquidity is a concept that many educators sort of make too complicated. Because in very simple terms, liquidity basically refers to how easily an asset can be bought or sold without causing a big change in price. And when I talk about asset, this can be anything from, stocks, cryptocurrencies, Forex pairs, and so on and so on. And something that is high liquidity is something that you can sell right away. It's easy to sell and you won't really affect the market. Think of things like, for example, Bitcoin or a large stock or a common Forex pair. You can easily buy and sell that. So in simple terms, it's a measure of how quickly you can convert your investment to cash at a fair price. So you can basically think of liquidity as the crowdedness of the market. The more buyers and sellers we have, the more liquidity. But now then, why does liquidity matter? Why is liquidity so important to understand as traders? Well, the first thing about liquidity is that it leads to a tight bid-ask spread. So in highly liquid markets, the difference between the buying and selling side is small, which leads to cheaper trades, right? It will be cheaper to trade in highly liquid market. Another very key thing is low slippage. So you can enter and exit larger positions without moving the price. So for example, if some of you guys watching are very large traders, you know that if you are trading a small stock or small, for example, altcoin, you yourself can actually move the price a lot. And that is something we preferably want to avoid. Another very nice things about liquid markets is market stability. So high liquid markets tend to be less volatile, and volatility here is a very, very important concept to understand. And I actually have a video about volatility, so I highly recommend checking out that video after this one just to get a deeper understanding of volatility. But they tend to be less volatile and more resistant to manipulation by large players, or in other words, smart money. I do have many videos on smart money trading as well, so I highly recommend to check out these courses after this video. Last but not least, it's easy to enter and exit liquid markets. But alright, so now let's take a quick look at some high versus low liquidity markets. So some examples of high liquid markets, or in other words, markets that we can easily get in and out without moving the price, are, for example, major Forex pairs like Euro USD, large stocks like Apple, Amazon, Nvidia, and so on and so on. And we can even talk about markets like US Treasury bonds. While low liquidity markets, as I already mentioned, are, for example, penny stocks, very small altcoins, small cryptocurrencies, and also tinely traded commodities. But alright, so now it's finally time to talk about why I think many of you guys are even watching this video in the first place, and that is liquidity grabs and liquidity sweeps. What are they and how can we trade them step by step? Well, liquidity grabs and sweeps are strategies used by large players to find sort of counterparties for their trades. Or in other words, these moves target areas where we have many stop loss orders. This is very important. And you will understand that very soon. But first, we need to understand that there's a slight difference here between liquidity grab and liquidity sweep. Some traders will use them in the same way, that they mean exactly the same way, but there are a bit of nuance here. So let's first take a look at the liquidity grab. A liquidity grab is a quick, targeted move where the price briefly breaks a level or pierces a level with a lot of orders and then snaps back. So what we're looking out for here is, first of all, brief duration. So it's usually just one candlestick and usually just a wick above a support or resistance level. As you can see here, it shows up as a long wick on the chart, and price immediately reverses direction. It often also looks like, or is called, a fake out. So very soon we will take a look at an example of how to trade the liquidity grab step by step, where to set your profit target, where to set your stop loss, and so on and so on. But first, we need to also take a look at the liquidity sweep. So in general, this is a sort of broader push through a liquidity zone, or a larger sort of supply and demand area. Sometimes the liquidity sweep can actually last multiple candles before eventually reversing. So in general, liquidity sweeps tend to be longer duration. They tend to also push further beyond the level, and the reversal can be more gradual. So liquidity grabs tend to be more spiky. Liquidity sweeps can be a bit more gradual, but it should still go pretty fast. And one sort of dangerous thing about the liquidity sweep is that it can trap many traders. But here, and this is very important, we as small traders can actually use liquidity grabs and liquidity sweeps to try to trade in the same direction as smart money. And here, as for the common targets, I do think this is much easier to just show on the chart instead of, using text. So now, guys, let's jump into TradingView. Alright, guys, so now we are in TradingView. By the way, if you for some reason don't use TradingView yet, I have a special link to TradingView. You can use that link to try out the best version of TradingView for 30 days for free. And if you eventually decide to want to upgrade your plan, you will get a $15 bonus. But now let's take a look at how to trade the liquidity grab step by step. So first of all, right now we're looking at the Bitcoin, we're looking at the BTC on the 30-minute time frame. But you can find liquidity grabs and liquidity sweeps on pretty much all time frames. And the first thing I want you to notice about this chart is that we have a very clear resistance level right here. You can see that the price got rejected not only one time, 2 times, 3 times, 4 times here. So we have multiple reactions as resistance right here. And when we have such a clear resistance level, what many traders usually do, imagine traders that are going short here, that bet that the price will go down, they usually tend to place their stop losses either at the resistance, so somewhere around here, or just above the resistance. And this is actually very important because this is what the smart players will use when they perform their liquidity grab. So what smart money do here is that they push the price up into these stop losses. And what happens when the stop losses of short players trigger? Well, the short players have to buy back, which leads to the price going even higher. And as we can see, this is exactly what happened with this wick right here. Now, when the smart players successfully have pushed the price up, they can actually sell, which leads to this quick wick here to the downside. The smart money makes a profit, while retail traders like me and you get liquidated, and we get stopped out of the market with a loss. But how can we as traders actually trade and use this principle ourselves? Well, one of the best strategies and one of the most simple method to trade the liquidity grabs is to enter at the candle close just below the liquidity zone, or in other words, just below the resistance zone right here, where we had all the stop losses above. And as for the stop loss, the by far easiest and also a great place to set your stop loss, I hope you can see here, is to set it just above the wick, the highest point of the wick when it comes to when we are shorting, and the lowest point of the wick when we go long. So we set the stop loss just above right here, and using a simple 2-to-1 risk to reward, which means that the green area here is twice as long as the red area, would have your target right here. And as you can see, this trade played out perfectly. But now then, what about the liquidity sweep? Well, remember here that the liquidity sweep is a slower move. The liquidity grab tends to be just one wick, while the liquidity sweep can be multiple candles. So here we actually have an example of a liquidity sweep. It's not a perfect example, far from a perfect example, but remember here, in real markets, it's very seldom you will find these perfect trades you see in textbooks. But the principle here is the same. You can see that we had a clear bounce right here. We even saw some, demand coming in. We retested this area as support 1 time, 2 time. So here is an area that many traders are likely to pay attention to. For example, traders that bought here and here might place their stop losses just below support, for example, here and here. This is a strategy that smart money traders can use, so they can push the price down, liquidate these stop losses, which leads to an even lower prices, which they can then use to push the price up. But this is a bit of a more slow process compared to the very violent grab here. But the the trading strategy is very simple here. In this case, I would probably enter the long position either here at the candle close, or I would wait for one confirmation candle, because this confirmation candle right here, you can see actually pushed above the support area. Once again, for me, the the stop loss is very clearly defined. I pretty much always want to place the stop loss below the extreme of the liquidity sweep. So you can see I set the stop loss below this point right here. I leave a little bit of wiggle room, and to keep it very simple for this video, let's just use a 2-to-1 risk to reward ratio. And as you can see, this liquidity sweep, it took a few candles, but we eventually locked in some nice profit. But right, guys, so if you want to learn more about how smart money trades, I highly recommend to check out my full Wyckoff trading course right here on YouTube. To do that, simply click or tap right here on the screen. I hope I will see you all over there very, very soon.